So it's hard to escape the excitement, possibly the mania surrounding artificial intelligence or AI. And of course, the latest example of that tool for generative AI is ChatGPT. A quick Google search yields over 762 million search results for the tool with an original release date of 11/30/2022. That's just last November by a company called OpenAI. Now, ChatGPT, it's a chatbot, allows you to ask a question and request the format of your answer. So you can say, hey, write me a 500-word summary of the American Revolution, and you'll get a nice essay back in the subject, researched and referenced across the internet. Now, in a story reported in a recent Economist magazine, it turns out that the bot can also write research legal briefs, but perhaps not quite ready for the Supreme Court appearance, as one lawyer found out when ChatGPT invented legal precedents to fill in its missing arguments. The judge wasn't amused. Now, NVIDIA is a company closely associated with AI boom because they make the AI specialist chips, the network chips, and even the AI platform software that's very popular with programmers, which conveniently runs exclusively on NVIDIA chips. They have the whole AI ecosystem in place. Now, since ChatGPT was released in November of 2022, NVIDIA's stock price has increased dramatically. As of Friday midday, it was up just over 130% since that November release date of 2022. And it's not just NVIDIA. 2023 has seen the re-emergence of the biggest tech stock companies, with their stocks regaining market leadership, with returns ranging from Microsoft at just over 36% to NVIDIA, now part of the big tech club, with a 2023 return of over 166%. The other big 8 companies include the old FANG stocks of Facebook, now Meta, Amazon, Apple, Netflix, and Google, plus Elon Musk's Tesla. It's understandable why investors and the media are attracted to these stocks when comparing their 2023 returns with SPY, which is just an ETF that tracks the larger S&P 500 US stock index. Now, the 2023 story has been so good that it's tempting to forget how these same companies' stock prices performed in 2022. Meta and Tesla were down over 60%, and even the newest star, NVIDIA, was down over 50%, while the S&P was down too, falling just over 18%. It wasn't nearly as bad as this group of 8. Now, are there any investment lessons to be learned from this AI big tech story? I grew up in Iowa City, and I was a big Hawkeye fan in the 1960s and 1970s. That ages me a little bit. Those are the years when Iowa might win 2, maybe 3 football games. At the time, the Big Ten was known as the Big 2 and the Little 8, reflecting the dominance of Michigan and Ohio State. I still cannot root for the Buckeyes, whose mascot I call a worthless nut. Lately, the S&P 500 can seem like the Big 8 and the Little 492, reflecting the dominance of the Big 8 tech names. While the Big 8 are only 8 companies out of around 500 in the S&P 500, they are so big that they represent over 27% of the value of all the stocks in the index today. This means that their combined stock price movements contribute, for good or ill, about 25% of the total gains or losses in the market if you think of the S&P as representative of the U.S. stock market. So in 2022, over 11% of the market's 18% decline was due to the Big 8 being down 39.6%. The other 492 companies were down a combined 9.92%. You would have been better off not owning any of the Big 8, down almost 40% versus down just 10%. Now, in 2023 so far, the Big 8 are up on average over 50%, and their contribution to the S&P's total return has been 10.21% of the 11.94% total return. The Little 492, well, they're up just above 2.2%. An investor this year would have been better off only owning just the Big 8, 50% return versus 2.2%. Now, even with the great first half of 2023, though, across the almost 18-month period going back to January of 2022, an investor would have been better off staying away from the Big 8 as a group. They were down over 9.5%, while the Little 492 were down only 7.8%. So who knew in advance? Well, not ChatGPT. It didn't even exist yet. The last 18 months, they retell an investment story that we think applies at all times, and it's this. Diversification can be both a risk manager and a return enhancer, depending on your lens and your time frame. Most people get the risk management aspect. Diversification keeps you from putting all your eggs in the wrong basket at the wrong time. If an investor had come into 2022 betting on the big eight continuing to outperform as they had in 2020 and 2021, that non-diversified portfolio of only 8 stocks, then just the big 7, because NVIDIA wasn't a big deal yet, would have created a significant loss. So how does diversification potentially enhance return? Well, imagine after 2022 that an investor decided that the big 8, again, nobody even included NVIDIA yet, had run out of steam, and after 2022's losses, it was time to get out and stay out. That decision to reduce diversification, to completely avoid a large part of the market, would have resulted in missing out on what turned out to be some great returns so far this year. By staying diversified, returns ended up being enhanced, holding the surprising winners. Now, because it's hard, if not impossible, to predict which stocks will be great or dismal performers and when that's going to occur, a better approach has often been to stay diversified. By owning the whole market, you won't miss out on the big winners whenever they win, and you won't be overexposed to the biggest losers when they surprise to the downside. You can see SPY, the ETF tracking the market, is in positive territory for the past 18 months, while 7 of the big 8 are still negative. On Friday, after I'd completed my research for this presentation today, as a test, I asked ChatGPT the question, why should an investment portfolio be diversified? Now, I promised I asked the question after I had written today's presentation, but as you can see from the summary, I fully agree with the artificial intelligence's answer on this one. Unlike the lawyer who was unhappily surprised by the chatbot's version of research, balancing risk management with the potential for higher returns should be high on the list of priorities for all real-life investors. Thanks for joining us today. We enjoy putting these presentations together. If you have questions or things you'd like us to address in the future, please let us know at the contact information you see on the screen. We hope to see you in a couple weeks. Until then, be well.